Statistics show that the most likely emergency that one would face during his lifetime is the one related to a health emergency. The second emergency, though less likely, but the one that will leave a devastating impact on your family, relates to the one of an untimely death. While there is little that can be done to prevent the occurrence of these events, you can do a lot to ensure that the financial impact of these events on your family is minimized through the help of insurance. What exactly is insurance and how does it work? Let's have a look at it. When you buy an insurance policy, you pay a small amount of money, which is known as the insurance premium, to an insurance company who will insure you against the happening of an event. It can be the untimely death, it can be a medical emergency resulting in hospitalization, it can be a car crash resulting in a damage to your car. The event can be anything. There are multiple events which can be insured, but under an insurance policy, if that event happens, that is the only time when the insurance company will compensate you an amount which is equal to the sum assured for which you took the policy. If you look at insurance, it is largely divided into two categories, one known as life insurance and second known as general insurance. As the term says, a life insurance generally gives you a cover for one's life. So if you decide that at the age of 26 you buy a life insurance policy and you want to cover yourself till the age of 65, then what happens is every year from the day you buy the policy, that is at the age of 26, you will pay a certain premium to the insurance company. Under the terms of the policy, your life is covered till the age of 65. So if something happens to you and you were to have an untimely death at the age of 50, then your nominees will receive a lump sum amount from the life insurance company, which is known as the sum assured. So here the payout is happening to your nominees on the occurrence of an event, and the event being an untimely death for you, who is the person who was insured under the life insurance policy. Any insurance that covers all other events which are not related to the life of a person is known as a general insurance policy. The most common general insurance policy that you would be aware of or familiar with is a motor policy or a motor insurance policy, because it is mandated by law that if you were to drive a vehicle on the road, be it a two-wheeler or a four-wheeler, the vehicle has to have a third-party insurance. What happens under a motor insurance policy is that if there were to be an accident and anybody is injured in that particular accident, he can be taken care of as a result of the insurance cover the vehicle carries, and irrespective of his economic status, he is not left to fend off for himself as a result of an accident caused by a motor vehicle. So you can see that in this case, in case of a motor vehicle insurance, the event happening is an accident as a result of which somebody gets injured, and then he needs to be compensated for the medical expenses. An additional part of this policy also is the car or the two-wheeler getting damaged and the owner needing to get compensated for the damages of the car that happened because of that particular accident. General insurance covers a large variety of such events which do not affect the life of a person, including motor insurance, health insurance, property insurance, agriculture insurance, theft insurance. There are a large variety of insurances which get covered under general insurance. The objective of insurance is to compensate you if a particular event happens for the amount of damage that you face as a result of that particular event happening. Let's look at life insurance in detail while we pick up medical insurance as a subject of discussion in the session 3. Though not mandated by law to have a life insurance is an extremely important cover that you must have as an individual, as it protects your family financially in case of your untimely death. Before we do a deep dive into the kind of life insurance that you must have, let's get familiar with some of the terms that you must know so that you understand exactly what you're getting into. The first is the premium amount, which is basically an outflow for you, or it is the cost that you incur in order to get an insurance cover. So every month or every year you pay a certain premium to the insurance company, who in turn gives you a sum assured if a particular event happens. In case of life insurance, the event is an untimely death. So as long as that particular event happens, you will get a lump sum payout from the insurance company, and the amount of payout you get is known as sum assured. And you will get this sum assured if the untimely death is of the person who is insured as a part of the insurance policy, and that person is known as the life assured. That is the person or the individual. In case of his death happening, it is only then that the insurance company would pay out a lump sum amount to you, which is known as a sum assured. Policy tenure basically refers to the period during which, if the event happens, the insurance company would make the payout to you. So a life insurance policy can be for 5, 10, 15 or even for 40 to 50 years plus. As long as the event happens during the policy tenure, the insurance company is liable to pay out the sum assured to you, as long as you have been constantly servicing your premium amounts as payable under the insurance policy. Some of the additional features associated with a life insurance policy are that the insurance premium is fixed for the tenure of the policy. So if today at the age of 25 you decide to take a policy which covers you for the next 30 years, the premium that you need to pay each year is going to remain fixed and is decided the day you take the insurance policy. So whatever is the premium fixed today when you take the insurance policy, the premium remains fixed for the next 30 years and does not increase as you age over time. In case of the unlikely event of death of the life assured, what will happen is the lump sum amount, which is known as sum assured, gets paid out to the nominee of the policy. So when you take a life insurance policy, you nominate someone to receive the money in case of an unlikely event of a death happening. As we discussed, the coverage is available only for a specific period of time, that is from your age 25. If the policy term is 30 years till your age 35, then this coverage is applicable only for this 30 years and not beyond that particular period. One thing you need to understand is you need to be able to differentiate between maturity benefits of a policy and death benefits of a policy. While the maturity benefit of the policy is the amount payable to you on maturity of the policy after 30 years, so at the age of 55, when 30 years have passed, what gets paid out to you at the end of 30 years is known as a maturity benefit. And the reason you receive a maturity benefit is because you have lasted the entire 30 years of the policy, nothing has happened to you, so there has been no event resulting in the company giving you a lump sum payout. So on maturity, they would pay out a certain amount to you, which is known as a maturity benefit. And death benefit is something which gets paid out if an untimely death happens during the tenure of this policy of 30 years. With this basic understanding of how life insurance works, what is extremely critical here is having adequate life insurance. Adequate meaning you have enough life insurance to take care of the financial impact of the event of an untimely death. Most of the investors that we talk to, they do have a life insurance, but they do not know if it is adequate, nor do they know how do they arrive at how much life insurance is adequate for them. When you insure your car, it is very easy for you to arrive at the value of the car because you just paid a certain amount to buy the car and you know what is the amount of the car that needs to get insured. So if you buy a car for 7 lakhs, your insurance policy also would have a sum assured of 7 lakhs, which is to compensate you in case something were to happen to the car in the event of an accident. Now, if you take the same example and take it to your life insurance, it is difficult to assign a value to an individual's life. While emotionally every individual is priceless, financially there is a way to arrive at the value of life insurance one must have so that your family is not adversely affected financially in the happening of an untimely death. Let's look at some of the ways in which you can compute the life insurance amount that you must have as an individual. The most commonly used methods are the underwriter's thumb rule, the income replacement value method, the expense replacement method, and the human life value method. Let's pick up the first one, which is the underwriter's thumb rule method. This method is the simplest of all the methods and also helps you arrive at the value of the insurance you must have very quickly. As per this method, the amount of insurance that you need is equal to 12 to 15 times your annual income. So if your annual income is 10 lakhs, 15 times that gives you your sum assured of 1.5 crores. So that is the amount of life insurance that you must take, so that if something were to happen to you, a lump sum of 1.5 crore can be paid out to your family. Now to check whether this amount is enough, let's do a quick working where with an annual income of 10 lakhs, you took a 15 times multiplier and you took a life insurance cover of 1.5 crores. Now what happens is, if something happens to you, obviously you cannot be replaced emotionally for your family, but you can definitely replace yourself with a corpus which is equal to the sum assured of 1.5 crore. If you were to invest this 1.5 crore in the safest of the products, say a debt product, and earn a return of 8%, you will earn an annual income of 12 lakhs per annum. And taking into account taxation, which can vary from person to person, if you are in the 20-30% tax bracket, say on an average you are left with 10 lakhs per annum post your taxes. That kind of works so that it replaces your annual income with the annual income which the family can get from the corpus which you've got from the insurance company. So by using a simple thumb rule of 12 to 15 times your annual income, you can arrive at the amount of insurance cover you must have when you look to buy a insurance policy for yourself. As we discussed, the amount of cover that you take, which is also known as the sum assured, should be enough so that you can get replaced financially for your family, and on your not being around, they should not be affected in terms of their finances being depleted, and they would not be then able to maintain the lifestyle which they had when you were around for them. From here, let's move on to the second method of computing your life insurance, which is known as the income replacement value method. Now what this method does is, this method multiplies your annual income with the number of years that you expect to earn the income till retirement. This income is calibrated a bit so that you take what is known as the current after-tax income and not pre-tax income. You take into account the expected income growth rate year on year, because if you work for next 25-30 years, you will factor for a certain amount of income growth rate. And finally, the corpus that you arrive at, you will want to discount it to today's value using an after-tax discount rate, so that you are able to arrive at a corpus which is able to replace an annual income that is expected if you were to be around. So if we take the same example and arrive at the annual income, so we've assumed the annual income of 7 lakhs, which has been adjusted for the various factors we talked about, multiplied with an expected years till retirement of 25, that gives you a sum assured of 1.75 crore. Given how the income replacement method works, it tends to give a cover which is higher than the method one we discussed above. The exact amount will also be affected by the variables that you take into account, such as your after-tax income and also your expected income growth rate and your discount rate. The third method of arriving at the amount of sum assured that you must have when you are taking a life insurance policy is the expense replacement method. This method basically goes on the premises that since you as an individual were funding a certain amount of expenses for your family, you would want to arrive at the amount of premium by computing the total amount of expenses that you provide for and how many years you would provide for if you were alive. To this amount, we make a certain adjustments to arrive at the final amount of sum assured that you should take when you take a insurance policy. Let me take an example to explain this to you. If you are funding your family expenses to the extent of 5 lakhs per annum and you are expected to provide for your family for the next 20 years, So your sum assured would come to 5 into 20, which is 1 CR. To this amount of 1 CR, you would go ahead and add all your outstanding loans. If obviously something happens to you, these loans need to be repaid. So you would add these loans to your amount arrived at in the part 1, so that your life insurance is enough to take care of these liabilities as well. So you will add all your outstanding loans, say a car loan of 5 lakhs, a credit card debt of 50,000 and a home loan of 30.5 lakhs. To this amount, which takes care of all your living expenses and your outstanding loans, you will go ahead and add an amount that is required for your future goals. So if you need to fund your higher education of kids, need to fund the marriage of your kids, you will go ahead and add these amounts, because at the end of the day, tomorrow when you are not around, these goals have to be taken care of, and they will be taken care of by the insurance corpus that gets paid out. Once you arrive at the total of the part 1, 2 and 3, from this what you will subtract is all your life earnings. So if you have certain investments in mutual funds or certain investments in property and certain cash in hand, you will go ahead and subtract these amounts to arrive at your life insurance required. So if you do a total here, it is 1 CR as per the amount of annual expenses that you fund, plus outstanding loans of 36 lakhs, plus the amount required for all your future goals which are unavoidable, that's 50 lakhs, minus your existing investments as of today, that is 41 lakhs. This gives you a sum assured of 1.45 CR. One thing you must keep in mind is when you're subtracting your investments, these are only your portfolio investments and do not include your personal assets like your personal home, because that is not going to be available for sale to meet your requirements to either fund your goals or to repay your outstanding loans. So all your personal assets will not be subtracted when arriving at the amount that is sum assured you should look for when taking a life insurance policy using the expense replacement method. Obviously, as your goals change over time, as your requirements change, the amount of insurance that you would need using the expense replacement method also would change with changes in your goals and requirements. The fourth method, and also the most complicated method to compute your life insurance sum assured amount, is the human life value method. The human life approach is a method of calculating the amount of life insurance a family would need based on the financial loss they would incur if the insured person in the family passes away today. Since the value of a human life has economic value in relation to other lives, such as a spouse or a dependent child, this method is typically used when you are computing the life insurance required for a family, because there you have multiple members who are earning and also multiple dependents in the form of children. There are a number of factors that are taken into consideration when computing the life insurance amount required under the human life value method, which include your current age and the age you wish to retire, your monthly expenses, your outstanding loans, your contribution towards the family expenses, which will help determine your economic value for the family, and also your existing life insurance cover if you have any, and your existing savings as of today. While the human life value method works well if you are looking at the insurance required as a family, for now as an individual you can pick any of the first three methods to arrive at the amount of life insurance that you need, and the easiest one being the first method, which is as simple as 12 to 15 times multiplier of your annual income. Before we go ahead, I would ask you to pause the video for a minute and actually compute the amount of life insurance that you need as an individual. You can make a note of your annual income and use the first method, wherein you multiply your annual income by 12 to 15 times. You can choose a number based on how comfortable you are in terms of the amount of cover you think you need, and arrive at how much life insurance that you need, so that if something were to happen to you, you are replaced with a corpus which will at least take care of your family financially. Once you know the amount of life insurance you need, the second question you need to ask yourself is, how long do I need this insurance for? Conventionally, the amount of insurance that you need is required only till the day you retire. Why? Because the life insurance is meant to replace you financially. So as time passes, what would happen is, by the time you move from your age 25 to 35 to 45, you would definitely start accumulating some amount of money, which is a corpus or the investments that you accumulated. And by the time you reach the age of retirement, you have planned for your retirement. We have seen it was one of the goals which when we discussed the financially free number, it is you have planned for your retirement. So when you actually reach your retirement age, you don't plan to work and you're not dependent on any income from your work once you reach your retirement age. By then, you have already accumulated a corpus which is now going to start sustaining you in terms of your day-to-day expenses. So technically, you need your life insurance only till the date of your retirement, because it is assumed that by then you would have accumulated a corpus which will take care of your future living expenses. So if something was happened to you the day you retire, and if you do not have life insurance cover, by then you already have a corpus with you which will take care of your future life expenses which you had planned for your retirement. But in case of the untimely event, your family would not get adversely affected because the corpus is still available and they can depend on that. So the ideal age up to when you need life insurance is till the age of retirement, or till the time when you have adequate savings which will take care of the financial requirements of your family, and then you're not dependent on a external life insurance to help compensate for your financial loss. Though there are a lot of companies which offer insurance even beyond the age of retirement, today you have insurance companies offering insurance cover till the age of 99. Obviously, the longer the life insurance is offered for, the more expensive it gets. Whereas if it's for a shorter period, it's going to be cheaper for you to acquire. So technically you need life insurances till the time you reach your retirement age, by when it is assumed that you have a corpus which is in place and that can sustain your family till their life expectancy. You would take a life insurance cover for a period beyond your retirement if there are certain goals which you have not achieved, and these goals are contingent on you earning, say, a freelance income or otherwise, or those goals are dependent on you as an individual even after your retirement, and that is when you would think of taking a cover which extends up to the period till you achieve your goals. Now that you understand up to when you need your life insurance, the next question is, when should I actually take a life insurance cover? Should I take a life insurance cover today when I'm at the age of 22, 23 and getting into my first job, or should I take a life insurance cover at the age of say 28 or 30, or only after I get married? Here again, you must go back and look at the principle of life insurance. Life insurance is meant to compensate your dependents so that if something happens to you, you are replaced financially with a corpus and your dependents are not adversely impacted, at least in terms of their finances. So when you start off your job today at the age of maybe 22 or 23, and if you think that you do not have any dependents because your parents are independent, they have enough money to take care of themselves, and you are single, you don't have a family, you can always take the call of not having any life insurance because there are no dependents on your income. So technically you need not have a life insurance the day you start off. But if your parents are dependent on you the day you start, or on the day you start you have an education loan which you need to repay and you cannot expect your parents to repay for you, then definitely you must take a life insurance the day you start your first earnings. Another advantage of taking life insurance early is that the earlier you take a life insurance policy, the lower is the premium that you have to pay for it. Let me show you with an example. If you look at taking a term policy for 1.5 crores today at the age of 26 for the next 30 years, your yearly premium for such a policy is going to be 15,529. If you decide to take this policy 10 years later at the age of 35, you will have to pay a yearly premium which is higher at 22,320. And if you take this policy even later at the age of 40, the premium is even higher at 28,555. As your age increases, the premium increases because the risk for the insurance company who's giving you a life insurance increases with age. It is expected that the probability that something will happen to someone who's 25 is much smaller compared to the probability of an adverse event affecting a person who is, say, aged 40 or 45. That is why the earlier you take a life insurance policy, the cheaper is going to be the premium for the same sum assured. Now that you understand the amount of life insurance you need, till what age you need the life insurance, and when you should start taking the life insurance, let's look at the options that we have when we decide to go and buy a life insurance policy. When you decide to go and buy an insurance policy, there are 3 basic policies that you need to know of. Although there are a lot more variety, let's discuss the 3 basic policies that you need to understand. The first one is a term life insurance policy, which is a pure insurance product. The second one is an endowment life insurance policy, which has a mix of both insurance and investments. And the third one is a ULIP policy, which is also known as a unit linked insurance plan, which is a mix of again insurance and investment. Let's look at each of these products one after another. A term insurance policy is a pure insurance product. What do I mean by a pure insurance product? If Arjun at the age of 30 decides to buy a term insurance for 1.5 crore, he's bought this policy to cover him till his age of 60. As per the premium calculation, he is required to pay an amount of 15,529 every year to the insurance company. In case of an untimely death at the age of 50, by then he has paid the premium for 20 years, so he's paid a total amount of 3,26,109 to the insurance company, and because the event of his death has happened, his nominees will receive a corpus of 1.5 crores. So you can see that for a premium amount of 3.25, which is the investment he is doing so that he gets a protection from the insurance company, his family is getting a payout of 1.5 crores at the age of 50. Now let's look at a scenario if Arjun survives beyond the age of 60 and actually dies at the age of 70. What happens then is he is paid a premium for 30 years, that is from the age 30 till age 60. The total premium he has paid is an amount of 4.81 lakhs. But since nothing has happened to him during the term of the policy, which was the 30-year policy till his age of 60, he does not get paid anything by the insurance company. So when he passes away at the age of 70, there is no payout to him, but what his nominees have got is security and an insurance cover when it was required. When it was required till the age of 60, because that is when he was the earning family member. So for an amount of 4.81 lakhs, he got the cover of 1.5 crores for a period of 30 years. And after that, when he retired with a good corpus and he didn't need insurance after that. And even when he passed away at the age of 70, the corpus was available to take care of the requirements of his family members. So a term insurance product is a pure insurance product which will give you a payout only and only if the event of death happens, and if the event of death does not happen, then just like any general insurance policy, be it a motor policy or a health policy, there is no payout which is given to you as an individual. Before you buy a term plan, some of the things that you must note is, just like any product, you would want to buy the insurance policy also from a reputed company and a company which has been around for a long period of time. A good way to evaluate a company is to look at its settlement ratio, which is released by the regulator of insurance companies, who is known as IRDA, in the month of December each year. You can look at the settlement claim ratio, which basically explains the amount of claims that were received and the amount that was settled by the insurance company. It is extremely important that when you are buying a term plan, you will be asked to fill out a proposal form wherein you disclose all your details to the insurance company. It is extremely important that you fill out the proposal form in all honesty so that you are not hiding anything from the insurance company. And this includes factors like whether you smoke, whether you drink, whether you have any pre-existing illness within the family. All these factors should be disclosed at the time of taking the insurance, so that if tomorrow an event were to happen and the insurance company discovers that you were, say, a regular smoker and your death happened because of your habit of smoking, and you did not disclose that to the insurance company when you took the insurance policy, then they will refuse to give you the cover. So the very purpose for which you took an insurance itself gets defeated. That does not mean that if you drink regularly or if you smoke, you cannot get an insurance cover. You can definitely get an insurance cover, but because of your habit, the risk of something happen to you at a lower age is higher. So the insurance company is going to charge you a higher premium. So when you look at a typical insurance proposal, go through the various factors, disclose everything correctly. Even if that means paying a small extra premium, it can be higher by 10, 20 or 30% the premium amount, but at least you know that tomorrow if something happens to you, the insurance company is not going to refuse paying out the sum assured to your dependents for the very purpose for which you took this policy. A very commonly asked question is that if I do not get any payout, if I survive the term of the policy, then does it make sense to have a term policy? Now, to help you understand that, you must first understand what are the options available for you. For that, let's understand the second type of insurance you must be aware of, which is your endowment policy. An endowment life insurance policy is a combination of insurance plus some form of investment that is done in your name. To help you understand how it works, let's take the same example of Arjun, who decides to buy an endowment policy at the age of 30. Now what happens with the endowment policy is that if Arjun were to survive the term of the policy, then at the end of the policy he will receive what is known as a maturity benefit. If you recollect, we had talked about at the beginning of the session that a maturity benefit is something which is paid out on maturity of the policy, whereas a death benefit is paid out on the happening of the event of death of the life assured. So in this case, an endowment policy will pay out a certain maturity to him. Since an endowment policy pays a maturity benefit, the amount of premium is going to be substantially higher compared to the term insurance policy we just discussed. So for Arjun, whose age is 30 and a sum assured of 1.5 crores, for a term of 30 years, that is till the age of 60, he will need to pay a premium of 4.5 lakhs per year. If he were to die at the age of 50, till the age of 50, he has paid an amount of 4.5 lakhs per year for 20 years, which is equal to an amount of 95.35 lakhs. What the nominee would receive is an amount of 1.5 crores plus any bonuses that have become due to the nominees. Now this is in the happening of an event of death. Now what happens in case Arjun lives beyond the age of 60? If Arjun lives beyond the age of 60, obviously the term of the policy has expired, and by the age of 60 he has paid an amount of 4.5 lakhs multiplied by 30 years, that is the term of the policy, which is equal to an amount of 1.4 crores. That is the amount of premium he is paid for the 30-year tenure. Now on maturity, he will receive what is known as a maturity benefit. And the maturity benefit, if we assume that the policy gives him a return of 5% per annum, Arjun will receive a corpus of 3.21 crores at the age of 60. Here is where an endowment policy differs from a term policy. In case of endowment policy, at the maturity of the policy after 30 years, Arjun is receiving a payout of 3.21 crores. But you should understand that the premium that he paid to buy this policy was substantially higher at 4.5 lakhs per annum or 37,839 rupees per month. If you compare this with the premium of your term plan, it was only an amount of 15,529 per annum or 1,294 per month. So you can see that the endowment insurance policy has a component of both insurance plus investment, while the term insurance policy is a pure insurance cover policy and does not pay out anything to you if the event of death does not happen during the tenure of the policy. Whereas the endowment life policy has a maturity benefit, which was the 3.21 crores, which Arjun received, where we assume that the policy has given him a return of 5% per annum. If you were to compare both the policies, the total amount of premium that Arjun pays over the 30-year period is 4.8 lakhs, whereas the total premium that Arjun pays under the endowment life policy is 1.4 crores. So obviously it is an extremely expensive policy. The reason it is expensive is because it has both elements of insurance and investment. Part of the premium that you are paying to the company is going towards giving you a life insurance cover, and a major chunk of the premium that you are paying to the company is being invested on your behalf. And if you were to think of this as an investment product, an endowment policy forms a part of the debt investment for you as a individual. The reason being, endowment policies give you returns in the range of 5 to 6% per annum, and over a period of 30 years, this amount compounds at a rate of between 5 to 6%. So when you look at an endowment policy, since it has a component of both investment and insurance, the investment component is a pure debt component for you when you look at the policy from your portfolio's point of view. In case of the endowment policy, Arjun had 37,800 rupees which he was investing completely into the endowment policy each month. Instead of buying the endowment policy, which is a pure debt product, had he bought a term policy, he would be paying only 1,294 each month towards getting a cover of 1.5 crores. He is left with a surplus of 36,505 rupees, which he can invest as per his asset allocation. And if you recollect, we had arrived at an asset allocation of 70% equity and 30% debt for Arjun based on his risk profiling as a growth investor. If he were to invest this SIP of 36,505 each month into a portfolio as per his asset allocation, which gives him an expected return of 12.9% per annum, it will result in a corpus of 17.78 crores. Obviously, this corpus of 17.78 crores is much higher than the endowment amount of 3.21 crores. But what you need to understand here is that endowment plan is a pure debt product, whereas when I'm investing this money into my portfolio investment, which is a mix of debt and equity, I am actually taking a higher risk and a higher exposure towards equity, because of which my expected return from the portfolio is 12.9% versus an expected return of 5% from the endowment policy I bought. And obviously the returns of the mutual fund investments into equities are much higher than the returns from the endowment plan. That is why when you look at comparing these two products, you need to look at where do you want to invest your money. Do you want to invest your money in a pure debt product? Then endowment plan makes a lot of sense. Whereas if you cannot afford to put so much of your money towards a debt investment which is giving you a low risk, low return of 5%, that is when you need to look at alternatives to a endowment plan. To help you understand, if Arjun's savings were 50,000 per month, and as per his profile he were to allocate 35,000 into equity and 15,000 into debt, and to ensure that he has adequate insurance, if you were to take this policy which is going to cost him 37,800 per month, he's actually landing up allocating more than 70% of his investments towards debt, whereas his risk profiling says that he must be investing 70% of it in equity. So this product will not be a fit for Arjun, and he must look at pure term insurance as a product to get his life cover of 1.5 crore. Alternatively, if we take an example of Kabir, who has a profile of a balanced investor, and he used to invest 50% of his money in equity and 50% in debt, his monthly savings of 1 lakh get divided 50,000 each into both the asset classes. And if he were to take an insurance of 1.5 crores in the form of an endowment policy, which requires him to put aside 37,800, this can fit into his debt allocation of 50,000, and he can consider taking an endowment plan to meet his insurance requirement apart from achieving the investment in the debt portion of his portfolio. So what you see here is there is no straightforward answer of whether you should buy an endowment plan or a term plan. What you buy is a function of how does it fit into your overall debt allocation. As discussed before, an endowment insurance plan is a mix of insurance plus investment, and the investment is purely a debt component. So if you are a risk averse person, you can look at taking an endowment plan. If you are happy with getting slow and steady returns and you are more interested in preserving your wealth than in wealth creation, it is a good way to use an endowment plan to pass on the money to your next generation. Another benefit here is that whatever you earn as a corpus in the endowment plan, it is completely tax-free as of today. So the 3.21 corpus is going to be tax-free for you or for your nominees, whoever receives the money, versus if you were to do an investment in mutual funds, although it gives you a much higher corpus, it is taxable, but that is with any investment, right? Any investment you do into an equity and debt product, it would be taxable. But a small benefit which endowment plans have is they are tax-free. So the reason you look at an endowment plan is if it fits into your asset allocation of debt and equity, your debt portion can be considered to allocate towards an endowment plan. Having said that, look at an endowment plan if it fits into your asset allocation, or else the best option for most investors would be to take a term plan. Consider the amount you pay towards a term plan as an expense, and whatever is left after paying for a term plan is what you invest into your portfolio, which is allocated between debt and equity as per your risk profile and as per your asset allocation. Now that you understand both a term plan as well as an endowment life insurance plan, the third option that you have when you want to take a life cover is that of a ULIP, which is known as a unit linked insurance plan. This again is similar to an endowment plan, that this particular insurance has a combination of insurance as well as investments. So if you were to take a ULIP plan with a similar cover of 1.5 CR, what will happen is the premium that you pay would be a function of your age and would be in the range of the amount that you paid for an endowment life plan. Part of the premium would go towards giving you an insurance cover, and the balance premium would get invested in what is known as a ULIP fund. ULIP fund basically is very similar to a mutual fund, wherein you have a fund manager who is managing the fund, and when you as an investor pay the premium, part of the premium goes towards giving you a life cover, and the balance premium gets invested in a ULIP fund, which in turn will invest the money in any of the various asset classes. You as an investor can decide which particular asset class you want the money to be invested in, and the way a ULIP fund works is very similar to how a mutual fund works, where all the returns get paid out to you as an investor after the fund manager has taken his fee, and the final amount that you get or the maturity benefit that you get by investing in a ULIP plan is a function of how much the fund value grows to. So what happens is, at the end of the policy tenure of 30 years, the amount you receive is a function of how well your fund has done. So if you put money in a fund which invests in debt as an asset class, you will get a smaller corpus. If you've put money in a fund that invests in equity as an asset class, you will get a higher corpus amount. So the difference here is, unlike an endowment plan, in a ULIP plan, you get to choose how much amount you want to invest in debt or in equity, and that allows you to put the money based on your risk profile and based on your asset allocation. Now all the money that is invested in the ULIP fund gets paid out to you on the maturity of the fund, and in case you were to pass away before the tenure of the plan, so you had a 30-year plan, and if something happens to Arjun, that is our investor we've been taking as an example all through, at the age of 50, what will happen is the sum assured of 1.5 crores will get paid out to you as a nominee. So you can see that it is possible that the value of the fund which has got invested is much lower than the sum assured of 1.5 crores. The nominee will receive the minimum amount of the sum assured if something were to happen to Arjun as a policy holder. So a ULIP fund is a combination of insurance plus a mutual fund, as you get to select where you want to invest your money, whether it is in debt or equity, and also it has the insurance component which gives you a protection for your life, and that takes care of the exact reason why you first bought a ULIP plan. At different stages in your life, you would want to look at the various plans that we discussed. When you're early in your financial career and you're just starting off, it is a very good option to consider the term insurance plan as a way to get adequate cover. It is not uncommon to see that you take a endowment plan or a ULIP plan which gives you a cover of maybe 5 lakhs or 10 lakhs or maybe even 20 lakhs, only because you take the policy based on the amount of premium that you can afford. But what you need to understand is, if you take a policy which gives you a cover of 10 lakhs, whereas you actually computed the amount of life insurance that you need at an amount of 1.5 crores, if something happens to you and your dependents get a payout of 10 lakhs, how long is the money going to last for them? And then they'll have to figure out a different way to take care of themselves financially. Keeping that in mind, it is extremely important that you correctly compute the amount of insurance that you need and take that amount of insurance through any of the 3 options that we discussed. But generally in the earlier phase of your life, taking an endowment plan for a cover of 1.5 CR would turn out to be an expensive proposition. That does not mean that you do not take insurance because it is expensive. You take insurance which fits your budget and go and take a term insurance policy which is extremely cheap compared to an endowment or a ULIP policy for the same amount of cover. At some point of time in future, you can definitely look at adding a endowment plan or a ULIP plan which will fit in your asset allocation of debt or equity and take care of not only your insurance requirement but also your investment requirement. But to start with, you can look at starting with a pure term insurance product. As we wrap this discussion on life insurance, I would like to leave a thought for you. Life insurance, or rather insurance, is a product which no one will sell to you the moment you need it the most. Do you get the irony of the statement? Life insurance is a product that no one is going to be ready to sell to you at that point in time when you need it the most. The day you're hospitalized and you think that I should have had an insurance cover to take care of my medical expenses, nobody is going to give that to you. If something happens to you and you are on your deathbed and you think that I should have had a life insurance so that my family will get a corpus on which they can depend after I'm gone, nobody is going to give a life insurance to you at that point in time. And that is the irony of insurance, that nobody is going to sell you the product the day you need it the most. And that is why the best time to buy a life insurance product or a health insurance product is the day you do not need it. And also pray that you will never have to use your life insurance policy so that you have a long and a healthy life. Summing up this session, the amount of life insurance that you need is equal to the amount that can replace you financially so that your dependents don't have to fend for themselves in the happening of a untimely death. The amount of sum assured should be enough to take care of your family, and having a sum assured which is substantially lower will defeat the entire purpose of having adequate life insurance. Look at term plans as a way to start your insurance exposure, and as time passes you can look at an endowment plan or a ULIP plan to add on to your insurance requirements and also take care of your investment allocation into the asset classes of debt and equity. Since ULIP is an insurance cum investment plan, in case of death, you are paid out the sum assured plus the fund value in most of the cases. So as you can see that ULIP plan will pay out the sum assured plus the fund value, an endowment plan would pay out the sum assured plus any bonuses that have accrued to you, whereas a term plan would pay out purely just the sum assured because there is no investment component in it. It is just a pure life insurance product. With this, we'll wrap up life insurance, and the next session is going to be on the amount of health insurance that you need and the kind of options available for you as an investor.